The last situation where we might need a memo in the general journal for this chapter is situation number 4, and we've got to correct some errors. So even with computers, it's still easy to make an error when entering transactions, and there could be a million things. But we can sort of classify them into, there's some more common ones, I guess. So one way would be that we've made a mistake is there's an entry made to the wrong ledger accounts. For example, marketing expenses were entered as wages. Or maybe a sale to J. James was entered as a sale to J. Jones. Or a payment for rent was entered as a loan repayment. So that could be anything. Any sort of, was meant to go to one ledger, but it went to a different one. We could also get the amount wrong, particularly if it's like a number like this. A sale of 1110 was entered as a sale of 1100. So when there's a lot of the same number, or it's called transposing the zero, an extra zero in there, that could happen. This is a bit of a disaster. This is not necessarily the wrong amount, but because it's gone to the wrong account, we do have the wrong amount. And what we mean by this is a payment of $550 for wages. Now, wages don't have GST. Was entered as a payment of $500 plus GST. So that's kind of a big problem. That's going to be tough to fix that one. We've also got maybe an entry with the debits and the credits around the wrong way. So, for example, let's say that a receipt of $1,000 from accounts receivable was entered as a debit to accounts receivable and a credit to bank. It should be the other way around. The point is, the mistake could be anything, but we've got to fix it with a memo in the general journal. And what can happen if errors are not corrected? Well, let's look at our accounting process. Transactions happen. We record them in journals, which in this case is the general journal. Then we make an error there. So what happens is that when we do our general ledger, so we take our journal, the transaction there, put it in the ledger, well, there's now an error in the trial balance or in the ledger accounts. And therefore, we're probably going to flow through to an error in the financial reports. And now we're going to make really bad decisions because those reports are wrong. So don't we have like a checking mechanism? So earlier on in the course, we said, look, we do a trial balance and that's going to pick up a lot of errors, but we also said there's some it won't pick up. So for example, if an error does get made here and does flow through to in the trial balance, won't I find it? Like, won't it sort of, the debits won't equal the credits? And I should be able to find it. However, the problem is, we said earlier in the course, there's some errors a trial balance won't reveal. For example, when a transaction is recorded for the wrong amount on both sides, when the transaction was recorded in the wrong accounts, when the debits and credits were reversed, when a transaction is completely omitted, or when a transaction is recorded correctly but twice. Now, these are still going to be tough to find, but if we do find them, they're not going to get them from the trial balance. So we're going to have to find them and then fix them manually ourselves. And that's why correcting errors is so important. And we need to do it in the general journal before the financial reports are prepared. So a transaction happens, they're recorded in the journal, we make a mistake. Well, when we do our ledgers, hopefully we find it there. And what we do is we go back and fix it. So we're going to fix these in the general journal with a memo, and then that wipes out the mistake. We've got nice, clean financial reports that are correct, and we just sort of link that back to the theory and go, well, if we correct errors in the general journal, that's going to lead to faithful representation because those financial reports over here are now free from error. So they kind of reflect the real world now. And secondly, and most importantly, we've now got relevance. Why? Because we can make the best possible decisions because our financial reports have been fixed and corrected and don't contain any mistakes.